Mhm.
Hello and Assalamu alaikum. My name is Daniel Kamal and I am the Director of Research and Insights at LAMS Consultancy Group. Today we have a very special guest here with us. He went to MIT to study management sciences and economics and then went to Oxford to further study philosophy, politics, and economics. He has worked as an investment banker analyst at Morgan Stanley and has served as the vice president for private equity GIC Singapore. He has now come back to Pakistan and is the founder and the CEO of Sarmayakar, one of the largest venture capitalist firms in this region. So, Rabeel, before we jump into the intricacies of startups and the venture capitalist, I really want to talk to you about this term that you have coined Vapistani. Could you maybe tell us about the core ideology behind it?
Yeah, no, thank you for having me here, Daniel, and hello to everyone. I guess the starting point of Vapistani, there's really two aspects to it, and I also want to use this forum to clarify a slight confusion that might be occurring in the market where people are thinking that we might or I might be thinking of Vapistanis or people that are coming back to Pakistan as being superior, which is not the case. In fact, if you take Pakistan out of Vapistani, there is nothing to come back Vapas to. So the idea was really that not just physically, but also mentally, people that have been successful elsewhere outside of Pakistan would reconsider either coming back to Pakistan or engaging with our ecosystem in a way that can help bridge some of the gaps that exist. And that was really the prompt to how does one define this flow of people that are now getting re-engaged or might be coming back for a bunch of different reasons. And to see them come back or Vapasana was really has been a key component of what we see as the potential for Pakistan in the future as well. And I think that was really at the origin of the word, which is seeing more and more of such people making the call and the decision to come back or be involved with Pakistan again, hence the term Vapistani.
So, Rabeel, if you don't mind, I really have this question in mind. After operating at such a high level in one of the financial capitals of the world, what particularly made you come back to Pakistan? Was it a moral obligation, a sense of nationalism?
I think it was a combination of two things, primarily. One is, of course, you could take me out of Pakistan, but taking Pakistan out of me was going to be difficult and something that I lived with throughout my career. And so there was always, maybe I can say, Lot ke budu ghar ko aaye, yeah, dur ke dhol sahane, however many, kahawats we want. But it's always easier to come back home, and Pakistan has always been home. But I would be maybe not sharing the full picture if I didn't say that actually the opportunity here was so exciting that for the first time in my career, I felt that it would not be at the detriment of my career if I did move back to Pakistan. And that was really a key factor for it. And when people ask me what was the main driver, I've never responded by saying, hey, my parents were getting ill, so I had to come back, or that there's a family business that I had to take over for which I had to come back. It was always a combination of a great opportunity and being able to make a difference and start something in a line of work in which I had been trained, and being lucky enough to do it in my own home country, which also needs a lot of that help. So that was really the combination of factors which led to it.
All right, that's actually really great to hear. So, just for the sake of our audience, could you maybe just explain briefly what a venture capitalist firm does and how does Sarmayakar fit into the overall startup scheme in Pakistan?
Sure. So effectively, venture capital is a form of financing that startups or early stage businesses that have high growth potential are looking for. This financing for such businesses comes in a few different shapes, starting initially with maybe friends and families or angel investors, which typically would write smaller checks. But as these businesses scale, they need more risk capital to be able to capture market share and to continue to experiment with their offering, whatever they've brought to the market. So what we do is effectively we provide that venture capital in exchange for taking equity stakes in these businesses, and in the hope that with our involvement and capital, and hopefully also value add beyond just capital, the value of the company will be able to be increased over time. And then when we do eventually exit or sell our position in that business, it will be worth more than what we are putting in at the beginning. But because we take a lot of risk, and a number of our investments by definition are going to fail just because of the success rate of startups, we need to price our investment in such a way that the ones that do work out are able to not only generate a return for those specific investors, but also investments, but also cover some of the losses of the other investments that haven't worked out. And hence it's a high risk, high return type of asset class where we appreciate the kind of risk that we're taking, but at the same time are looking for a commensurate return to be able to pay for all these investments that we're making.
All right, so Rabeel, I do have a follow-up question on this. If I understand the structure of Sarmayakar correctly, and correct me if I'm wrong, your main fund is based in the Netherlands, right?
Correct. So actually, I should have answered the second part of your question as well, which is what role does Sarmayakar play? So Sarmayakar effectively acts as a venture capital fund, which has its own investors, typically also called LPs, limited partners of businesses. And our fund itself is domiciled. This pooling vehicle where every investor has invested into is based out of Netherlands, as you pointed out. The reason for that is just the fund regime that is applicable in Europe, and specifically out of Netherlands is more established and more conducive to the type of fund that we have versus incorporating in Pakistan locally. There are also some other factors around ease of doing business, flow of capital in and out of the country, which again resulted in this initial fund being based out of the Netherlands. And what we do is we basically pool together all the investments of our LPs, and including myself and my partners. And we then make investment decisions, which is made by an investment committee at the fund level. And that investment committee will decide which investments to put how much money into, whether to follow on in an investment. And over the course of the fund life, we are aiming to invest that fund across 15 or so businesses. And the idea is that we try to identify specific spaces that are interesting, that are high growth markets where capable teams and founders are targeting solutions that are required by the market, so that they can capture market share and generate, hopefully profitable long-term businesses. So that's really in the crux of what Sarmayakar does as a fund.
All right, perfect. So let's just get right into it. So as a venture capitalist, what would be an ideal startup for you to invest in?
I think that's a good question with a not a very specific answer. And the reason it's not specific is because different aspects or characteristics make a particular startup interesting. I think at the very core, what we need to realize is we're in the business of investing in people, and it really starts and ends with the team and the people and their vision and their ability to execute on a certain vision. Then I think what is important for us is really the space that is being addressed by a particular startup, or how we like to put it in our vernacular as the addressable market for that particular startup. It doesn't necessarily need to already be fully established addressable market at the beginning, but we need to take a view as to how quickly that market is growing and where will it be in 5, 7, 10 years time, when the startup itself might also be more scaled. Then, of course, there are characteristics of the business themselves. For example, what are the unit economics? How long will it take for the business to become profitable? Which means how much external capital will be required to fund loss-making operations, and whether that's viable in the market or not. So a lot of these characteristics are really brought together And then we also apply a little bit of a gauge on how well the capital structure is set up, who are some of the partners that the startup already has. And across these various different aspects, we will not grade them one by one, but really take a view as to whether the combination of those makes for an interesting startup that can capture market share. At the very essence of it, if I may boil down, and I think Paul Graham from YC mentioned this, that essentially there's only two things that a startup is looking for. One is to capture market share, and the second is to stay alive for as long as possible to capture that market share. And I think ultimately all of these assessments that we're doing are really to identify which horse and jockey combination will be able to win which race, and if that race is meaningful enough to run it. So to put it in layman's terms, that's what we're looking for.
That's actually a great way to talk about startups in such detail and such a personalized manner. So I really want to talk about some red flags. So I was watching one of the episodes of Idea Karono Ka, and you were on the judging panel, and two firms came to you. Let's call them firm X and Y. One of the firms offered you 15% equity for 2 crore rupees, and the other firm offered you 40% equity, 25% after break even for 8.3 million, which was eventually brought down to 8 million there and then. So for me personally, these were like really big red flags because in my personal opinion, if they're offering you such a big chunk of the company right now, I doubt that by Series C or even Series B, they'll have like 10% left in their own name. So like, is this a red flag in particular? And are there any other red flags that you particularly investigate before making an investment decision?
Excellent observation, and I think that is absolutely a red flag. At the very early stage, you don't want to be taking on, as an external investor, so much of the equity away from founders that there's little incentive left for them to build something. So that definitely is a red flag wherever we do see a situation where the cap table has resulted in early investors taking on too much equity, and they are also not then committing in subsequent rounds, means that you need to go out and find new investors every time, which means, of course, dilution on the one hand, but also just time taken up of the founder. So this would be a red flag for us. We would make it typically a condition of our involvement to have some sort of a restructuring of the cap table. We, in fact, even had to do that as part of Bykea. But the interesting element is that once you do it, you see actually a lot of these businesses coming back to the growth path and continuing to do well. Other red flags could be really around structures where if there are different ownership levels at the local opco and different ownership at a holdco level if that's set up abroad, or if there's some sort of revenue sharing agreements between specific investors, but not everyone. If there are multiple businesses a particular founder has his own incentive tied up into, and figuring out how they're going to split their time between the startup that we might be backing versus another startup. So all of these are, again, like red flags around the same consideration, which is what's the motivation of these individuals? What are the tools that they're going to be using to have their own kind of wealth generation, hopefully maybe even building their legacy through these big businesses that they're setting up? And aligning those incentives is a very key part of what we are looking to do and what we want to ensure every time. So any red flag that is an obstacle in building that trust and in getting that comfort that everything is on the same page, we would want to flag that early and address it before we get involved.
All right, so that brings me to the next set of questions. So what exactly are your next steps when you make the investment? Do you act as an active partner or a sleeping partner? Because when I was going over your portfolio and Sarmayakar's portfolio in particular, I saw that you were also the CEO of Patari, but you hadn't assumed a position in other companies as such. So maybe if you could guide me through that.
Yeah, sure. So I'll address Patari first because that was a very specific situation of a management transition. So I was for a period, the interim CEO, and that was just to ensure stability and survival of the business at that time. Now we do have Zarlash Faisal as the CEO, who was appointed earlier in the year, and it's her job to really build the business and continue it on its journey. But in terms of our involvement, when we go to the market, we mention like our capital comes with value add, and that definition of value add is not already predetermined by us. It's really determined by what the needs of a particular startup are. And we operate on what we call a pull factor, meaning we're available, we have infrastructure, full team, and whichever founder or team requires help in whichever aspect, they will ping on us or they will pull on us to provide that particular aspect or resource or input on those. To give some examples, the team helps all of our startups with their financial models, with their structuring. We have Mubarak Siddiqui, our in-house counsel, is arguably the most experienced lawyer in the startup space in Pakistan. And so a lot of that structuring support, just general legal help, we're able to provide in-house. Then we, of course, are involved with all of our companies at the board level. So there is whatever strategic input that is required and our responsibilities that we need to play as board members, we like to do that as well. And then, of course, there's regular reporting that occurs from startups to us as well. There's generally monthly data that we get, but also we look to organize both founder retreats, investor retreats, where we bring together our portfolio and our investors. We also are actually covering from our fund executive leadership training for the founders of our companies. And these are, again, Fortune 500 coaches from London. And all of this is, again, to try to make every leader that we back a more effective leader and be able to capitalize on the opportunity that we see, because their roles are also evolving over time. And so what we do is really try to gauge not just at one deterministic point or in a snapshot picture of what a company is looking for, but really over time, how different roles are evolving, where gaps might be occurring, and how we can plug those gaps. An important last point to mention on this is also hiring that we help do for our portfolio companies, because we have a platform which has many different businesses. So a lot of these Pakistanis that are looking at opportunities in Pakistan, or just generally folks that are looking to be engaged with this ecosystem, would be reaching out to us to find out where there might be opportunities. And so we play this matchmaking role in the middle as well of again, connecting our startups with either experts or potential hires or just learning from other ecosystem. And all of this we encapsulate in called building bridges effectively. And so to answer your question about involvement, we build bridges for every opportunity and every company that we back. Who is crossing on that bridge or how that's leverage is both down to the startup and also, of course, with some input from us in terms of where we feel there might be gaps that can be addressed.
So that actually brings me to a follow-up question. So on your Sarmayakar's portfolio, you have Patari, Bykea, Device, Simpesa, Project, and among and other startups as well. So is there a particular theme Sarmayakar follows when they're looking for startups, or do you just go for the highest return in the shortest amount of time?
Yeah, so I think, again, a good question. We do have a technology and technology-enabled lens that we apply for our current fund. And of course, there's a criteria of what qualifies as a Pakistani company versus not. But beyond that, we're subsector agnostic, meaning we want to see different spaces that can become large. And then within that, try to back one player that we hope can become a vertical leader. There are some restrictions in terms of sectors that we would not invest in. And these are driven by the World Bank / IFC regulations on this. And these are, again, the types of industries that you would typically expect very few funds to touch. So gambling, alcohol, arms and ammunition, etc. I think those are ones that we are unlikely to do from our fund. But beyond that, our current focus is across a bunch of different technology and technology-enabled sectors. But I believe by the time our fund is invested, we would have more weightage towards logistics and adjacent areas, and maybe fintech as the two most prominent areas from which we have exposure in the current fund.
All right. So regarding what you've said, I think that one of the main themes is digitization over here, because you've talked about fintech, and in Pakistan you have companies such as Finja which are emerging. But I personally feel like Pakistan is still lagging behind a lot of things when it comes to digitization compared to other developing nations within these South Asian regions. So like, where is Pakistan exactly lagging, and how can like the government of Pakistan and the individuals improve on this particular aspect?
Yeah, I think you're right in that we lag a lot of other nations in terms of how much are we already digitized, or how many of our sectors are already digitized. But that's a function of 3G, 4G enablement only occurring in like 2015. And frankly, there not being enough incentive for businesses to digitize, or for individuals to even adopt technology solutions. We've seen an acceleration of that during COVID. Now people who were not ordering their groceries online are doing that, medicines online, and even businesses that previously did not feel that they needed online presence now feel that they need it. So we've seen a little bit of an acceleration for it. But making this broader point of there not being enough incentive. Now, if you go to a Kirana store, which is ordering directly from a manufacturer and having that order fulfilled the next day, versus a week-long period of a traditional distributor and an order taker coming to the shop and then going, and the following week that order being fulfilled. So it's just a case of like, more convenience being available. In some cases also affordability getting impacted in terms of basic digitization and the first adoption of such technologies. But the challenge previously was that even if you did place this order, you didn't have the means of paying online. So payments are then become a requirement, and a lot of these are the rails on which the trains would go, and now we have more and more of those in place. So that's really one aspect, which is that the tools were not there. Now some incentives have also been aligned so that it's actually beneficial for people to adopt such solutions, etc. And at the same time, from a supply perspective, there are now also more innovative solutions which have been more effectively localized for Pakistan. If anyone wanted to just have digital payment options 5 years ago, basically did not have many options. Now you do have businesses that are, for example, even in the case of Bykea, all riders, the tens and thousands of riders, are paid digitally in their Easy Paisa or Jazz Cash wallets, because the company doesn't want cash to be involved. Now, this was again not possible a few years ago, but now that it is, it's become a requirement for the business that any new rider joining the platform has to have one of these wallets so that they can be paid effectively. And we're going to then hopefully see some of those individuals also not just go to the shop and withdraw all of that in cash, but actually keep a little bit in the wallet to use for other use cases. And then you start to create this financial inclusion net, and more and more transactions start to occur. So I think a lot of that is changing at a rapid pace, but we're starting at such a low base that it seems like we're very far off. But it might not take that long. I think in the next 3 to 5 years, I would imagine that a lot of us are going to be using digital payments, using the digital enabled or technology enabled offerings that are right now in the market and might appear to be novel. We might be more likely to be using them as like, given course of business, or like, how a typical day goes. So that's one aspect. The second aspect is there are also extensions or adjacencies within fintech, or one of the sub-segments that is centered around lending. And lending in Pakistan has been a challenge before, because we just didn't have enough data. Like, how do you determine credit worthiness of anyone if you don't know how they're transacting, what they're paying for, like, how regular are they in their payments? But now we're starting to build some of that data. So to carry forward the same example of a Kirana store that has been digitized, now those platforms will have visibility on how on the spending patterns of these shop owners, and how frequently they're ordering, what they're ordering, what's the size of their likely sales are. And off the back of that, you can come up with lending products or working capital lines for these Kirana stores, which is a big, big opportunity in Pakistan. So I think we are going to see more and more of such solutions come through as the market matures, and there's just more transactions taking place, which can be then leveraged to make informed decisions about other adjacent offerings.
So, Ria, I'm actually very glad that you mentioned Kirana stores, and I have this view regarding this type of disruption. So, when an idea such as this comes in, like digital payments and digitization, I think there's a particular cost to this, because right now you have a supplier, and then you have a middleman, and then you have a consumer. So, what essentially digitization has done is, I think, remove that idea of a middleman so that the supplier can go directly to the consumer. Now, that's very direct and very convenient. But the middleman is now out of the equation, and like he's essentially out of business as well. So do you think that disruption has a cost, and how can that cost be actually solved and resolved in a certain way?
I think that's an excellent point, and my response to that is it doesn't necessarily need to be. I think what we need to happen is both, like, when technology is being used to disintermediate or remove a middleman, I think there needs to be some consideration given to what is the role being played by those middlemen, and if a technology platform can cover all of those roles, then by all means, there may be that middleman's role will no longer exist. But the reality is, it's not that easy to replicate. So, for example, to use the same example that we were talking about, the distribution networks of these distributors and these order takers are so widespread and so well established, and work in the economics that are available in Pakistan, that any platform that comes and says, okay, we'll take an order directly and then fulfill it ourselves as well, also needs to then have a similar network to be able to fulfill at that kind of rate. So what you might see is actually some of these third-party providers actually plug into these platforms because they can just fulfill a particular function better and at a more effective cost compared to that one technology platform. So I believe that there will be like an evolution, and while there might be some cost in terms of specific segments that lose out, I think overall it will be a value additive exercise, because you're trying to remove inefficiencies from the market, and rather than seeing all of those wholesale goods being dumped in wholesale markets, where then these Kirana store folks have to go on their motorbikes and bring back all the stuff. I think that's an inefficiency that should be removed and ultimately should lead to value creation. There's that one thing. The second thing is also some of the examples we can take, and I want to use Zameen as an example, that have created tremendous value, but have they really removed or made real estate agents obsolete? No, their model was just slightly different to what other companies in the market have tried, which is rather than completely remove the middlemen, bring those middlemen on board so that they become part of that model. And so what you saw was real estate agents becoming members of Zameen and having no limitations once they became members and paid a fee to then have as much of their inventory on this platform, which was bringing a lot more eyeballs compared to just one physical store or one physical agency location that these folks had. So I think there's like, you know, some truth to both, where some sectors are going to see more disintermediation, more impact on the middlemen. Other industries will hopefully see, like, you know, more of a combination of newer players which are using technology to effectively scale, together with some of the traditional aspects of how those industries were operating in the country, and incorporate some sort of hybrid of the two.
So those are actually all very great points. So I'm glad you mentioned Zameen, because I've been tracking the funding Zameen has been receiving, and the recent funding it raised was from the KCK group, which is owned by an Italian conglomerate. And this is where it gets interesting, because I see a lot of funding when it comes like $20 million, $18 million. These are all foreign investments. Like, what I fail to understand is why aren't Pakistanis investing within startups within Pakistan? Because you see them investing in PSX, which is a very unreliable sort of stock market when compared to others. I just feel like, why is there so much outside foreign investment and nothing from within?
Yeah, no, I think again, good observation, and it's starting to happen. Like, this unlocking of local capital is also happening. Even in our own fund, we have some of the biggest families or conglomerates in Pakistan that have taken positions. Some of them are, and there are other funds as well, as you might be aware, that have some of them participating, and some are also writing direct checks. But the main reason why we don't see the same volume or the same sizes is these local businessmen or families have not experienced it before. Pakistan hasn't gone through a trajectory where people have made great venture returns, and for them to say, hey, we want also now allocation or exposure to this asset class so that they can make similar returns. It's starting to happen now, and the more exits we have, like Kareem, or even hopefully a Pakistani, a full-fledged Pakistani business exit, I think that will result in a lot more capital flowing into the space as well. And ultimately, what we're the reason why we see some of these external investors taking bets on Pakistan is, from their perspective, they have done this in other markets, most likely even emerging markets, and they see Pakistan as one of the last remaining 220 million plus population opportunity, which because of their knowledge of this asset class, they have an advantage in coming in early too. And I think this is something which we've seen across many other ecosystems as well, where foreign capital that is experienced, that has done this before, comes in and helps unlock some of the local capital as well. And that's what gets an ecosystem going. So we're just at the very early point of on that journey, but I think local capital will get unlocked, and hopefully we're going to continue to see an increase also in international capital coming into the country.
So Rabeel, I'm glad you talked about this. You just said that these people have tried this idea before and it worked, and now they're targeting Pakistan. But I'd like to quote you here. I once heard you say in one of your videos that the market is not ready for this kind of disruption. The market isn't particularly there. So my question to you is, like, if you have a very killer idea that you know has worked in other countries, when is the right time to disrupt the market?
Yeah, I think you one has to think about it in slightly different terms, which is, if a market is not necessarily there, is there a view to that market getting created, or can a startup come in and create that particular market? In some cases, that takes a lot of capital, and it will take a lot of time, and so it might work out in the long run, but it will require, like, again, just a lot of support for an extended period of time. The best example I can give of that is Daraz. When Daraz started marketing in Pakistan, people didn't know what e-commerce was, and so they had to educate everyone. They had to, like, again, build out a lot of these the last mile fulfillment functions, a lot of, like, the payment options, etc., which were developed as they were also growing. But it's just taken a long time, and it's taken a lot of capital. And the benefit of that is that now every other e-commerce player benefits from the spending that Daraz had. So I think that's where one needs to take a view in terms of particular segments, how mature and developed they are already, and whether, like, you can just come in and have an idea and start executing on it, or you really need to create a market around it. And so to answer your question specifically, there's no right or wrong time as such, but one of the biggest factors of businesses failing is getting the timing wrong. And sometimes the market is not ready for certain solutions, even though they might be very innovative and disruptive ideas. And so it just needs localization and contextualization for what is the need in Pakistan, or what is the problem in Pakistan that is being addressed, and whether the economics given our GDP per capita would make sense for an offering to try to address that problem. And if that seems that it will require a change in consumer behavior, that for us means that it's not something that we can back right now. It might change in the future, because no space remains static, and no assessment is static based on these fast moving and fast changing startups. So that's how we think about whether it's the right time for a particular startup or not, and whether the market is ready to take on an offering and support it, and ultimately have enough customers and funding available for it.
That makes a lot of sense. Just to personalize this question towards you in particular, when Sarmayakar started, I think it was in 2015 when you actually institutionalized yourself as a venture capitalist firm. Did you face a similar sort of problem? Because in Pakistan, us tarah ka culture nahi hai venture capitalist, and it was like the first time you're hearing this, oh, VC firm hai Pakistan mein. But now you have Indus Valley as well and other capital funds. So did you face a problem like this in the initial stages?
Yeah, so we went through exactly the same kind of challenges that a startup would face. One is just a lack of understanding in terms of both investors locally as to what we're doing, but also founders not necessarily understanding what venture capital entails and what we need to solve for. So there's been a tremendous learning that we've also had to go through, and thankfully now there's a little bit of a playbook. When we started, there was no playbook. So you had to also experiment and figure out what's the right way to go about it. And one of the things that we had to experiment the most on was, what is that solution that the market needs from a venture capital perspective? It's not just a check, and there's a lot of hand-holding that is required. What stage is the biggest gap on? How can we play a role to not just be involved and help businesses grow, but really also address their considerations for the next round, because it's really a continuum. It's a venture financing and venture building continuum that you need to keep going on, and that determination was what we were thankfully able to do in the first couple of years of our existence, which was really find, from our perspective, a product market fit. Our product is capital and value that comes with it, and there's a market for it. Of course, there's a huge dearth of early stage capital. So how effectively can we tailor that offering for the market? And thankfully, alhamdulillah, it's so far it's worked out, and no reason to believe that it won't continue to work out, because I think we're going to see even bigger deals. We're going to see more startups. We're going to see some more spaces now go through the digitization wave. So it's looking very good, inshallah, for Pakistan's future in this space.
That's glad to hear that something looks good in the future of Pakistan. So I'm sure you've read articles that Pakistan and Asian Tiger by 2050, or books like those, and they paint this picture that this will become a South Asian Silicon Valley or Wall Street. But my question to you is that there's the current issues we're facing right now, there's still so much political instability. It happens after every election. And there's also high rates of inflation. I mean, at one point of time, the interest rates were really higher than the returns you get on the stock market. So in your personal opinion, where do you see Pakistan in the next 50 or even 30 years?
Yeah, very good question. And to be honest, maybe I can allude to how I've taken a view on this, and I've kind of packed my bags and come back to Pakistan because I believe the opportunity is tremendous. And while that does not mean that we will not have any issues in 10, 20, 30, 50 years time, we might have actually even more issues, but that there's a lot of opportunity to fix things, to create value, to bring new concepts to life, to again effectively localize something that we've seen elsewhere, and address some of these challenges. And I think a lot of the macro developments, again, can be like, a little positive, or maybe negative, and go through cycles. But really, the opportunity is driven by the young demographic of the country. And if I'm to sum this up, we're 220 million population, roughly what 65% of which is less than 30 years old. And in a very consumption-oriented economy where 80% plus of our GDP is linked to consumption, those consumption patterns are naturally moving to digital sources. And it's really that natural evolution, and starting from a very low base, that sees tremendous opportunity for this segment particularly, but also hopefully with that continued growth and opportunity to for the youth to drive really, like, Pakistan's future. What are some of the risks in this are the ones that you had mentioned, which is, again, if there's political instability, if there's any an increase yet again on terrorism related activities, if there's big fluctuations or depreciation of exchange rate that might dent some foreign investor interest. But if I was to point out to the latest indicators on these, they're all fairly positive in a relative sense, and certainly moving in the right direction. For example, we are right now in the middle of our third consecutive civilian to civilian transfer of power. And our previous track record before this was zero. We never finished a full election, 5-year term, followed by another 5-year term of elected officials. We had like the military intervene. If you compare the terrorist incidents or extremist activities or the casualties as a result of which, we're down 75-80% compared to 2014 when the Zarb-e-Azab operation started. And again, these are like hard facts, which again are not going to be highlighted on Fox News, but are real. And I think that's really the perception reality gap that drives a lot of the opportunity in Pakistan. And in my biased view, ones that are able to look beyond that, the delta of perception and reality, really stand a chance to make great returns in the country. Because yes, it's risky, but like I said at the beginning of this podcast, risk comes with an expectation for generating return. And if you are looking to generate outsized returns on a risk-adjusted basis compared to any other part of the world, Pakistan right now looks very interesting.
That's exactly why I found this idea of Pakistan very commendable, because individuals like you who come with this huge experience and huge workings in like financial capitals and bring their expertise to Pakistan, these individuals are making a change. But right now, like I'll go to one very simple example. If a student like me wanted to go to the bank and open a bank account, I can't register myself as a freelancer, which means that I do have a certain deposit limit which I can't go over. Otherwise, I'll have to pay like about minimum 200,000 tax per year. So, like, what role can the government play to improve this idea of startups and entrepreneurship at such a for a young demographic, basically?
Yeah, no, I think that's again a good question, and it's not ideal in terms of where we are. But there's a lot of movement from the regulators, from the authorities, and that movement is to facilitate individuals like the ones that you've referenced in the example, because the government recognizes they can't absorb this youth bulge that is coming out of universities and provide them jobs. So they need to facilitate the private sector in doing that. And such facilitation comes with, again, measures that improve ease of doing business, with some of the specific aspects around the capital controls, or like, flow of money into the country or out of the country. Taxation is a big topic, even with the SECP incorporation of companies, etc. I can tell you both from my own involvement in many initiatives over this past few months and years, and also what we're seeing come to the market or being worked upon in the background, and you will hopefully hear of them in the next few months. There is a lot of movement in the right direction to address those. And if I was to take a snapshot picture at the end of this year compared to 2 years ago, end of 2018, it would look a very different, it would paint a very different picture in terms of how facilitated the government is indeed being. The challenge is that whenever there's an opportunity or whenever there's a policy change that is put in place to facilitate a particular segment, there's also a risk of a lot of loopholes coming up and people manipulating those, not for the intended purpose as we're discussing, but really to make a short-term gain somewhere else. And the authorities need to solve for those as well. They need to prevent those things from happening, which means that actually they need to deliberate a lot. They need to get input from industry. In some cases, they even need to put it to Parliament to approve. And that, of course, means it takes time. Not everything might get done. But if I'm completely fair to these folks, they've been very supportive and they've been wanting to have such changes made.
So that honestly gives me a lot of hope, and I think it gives a lot of hope to the viewers as well. So, like bringing our discussion to a close, I really want to focus on Sarmayakar and you personally. So, what does it take to work for Sarmayakar? Like, what do you see when you select your team? Because I've seen your team; it's very close knitted. I think about eight people, 7 people. So, what does it take to be in Sarmayakar?
Yeah, I think that's again a good question and not an easy answer to that. But I think the number one factor is really our culture, and we don't just talk about it. We document our culture. We've we have specific defined values, and I think as long as we're all buying into the same values and are working towards the same end goal, I think that we would be very open to considering having more people join us. And what really is at the essence? We are, of course, want to be very successful venture capitalists. So making that financial return is a very important part of it. In fact, I would say without that financial return, we would not exist. But I think it goes much beyond that. And the overarching trait, if I may, that we want to exhibit is really this pursuit of excellence in everything we do. And how do we define that excellence is through 4 core values that we like to exhibit. One is we like to be trusted partners because we believe this is a business of trust, and it involves having these partnerships both with our investors and with the investee companies that we're doing. We are again, we like to be trusted partners. We are conviction-led in that we try to build religion and conviction on every decision that we're taking. We incorporate different viewpoints, everyone's viewpoints, and once we take a decision, we want to stick to it and also be disciplined about it and honor that. So we need to make ourselves accountable if that doesn't work. Then we need to, of course, our third value is we are here for good, meaning that we want to have that longevity. We want to be doing things not just from perspective of making that financial return at the expense of long-term sustainability. So we want to effectively really be also doing good things, but think about our communities, think about the impact that we're having from our activities, and can hopefully build that on a sustainable basis. And the final point to mention, the final value is we're looking for returns beyond just capital. We want to learn from our mistakes. We want to learn from our experiences. We want to recognize everyone as being human and capable of making mistakes. But at the same time, we want to be contributors to generating those returns beyond just capital. And I think the capital return element is a given. But if we do a lot of other things right, hopefully we can continue to build ourselves and continue to as I like to put it, make a dent to the space in Pakistan. I think that's really our key motive. It was my own selfish motive at the beginning. If you asked me in a different interview, maybe I would have responded by saying my main motivator was to try to come here and become the first professional venture capital the country has capitalist the country has seen. So it's a journey, and I believe, like, anyone who buys into these values, buys into that same vision, and really wants to invest in the future of Pakistan, I think should be reaching out to us and hopefully working with us at some point.
That's actually great to hear, because when I started following Sarmayakar, I was actually, because people like you and people like Atif Awan, they've like kind of brought this idea of venture capitalism and these kind of different financial institutions towards Pakistan, and it has seeped into university students. So, like, if someone wanted to particularly work for you or learn from you at a university level, what message do you have for them? Do you recommend a set of courses, a set of skills to acquire? What?
Very good question, because I think, inshallah, next year I'm going to be starting a venture capital course. In fact, at LUMS. So I was there last week discussing with the associate dean of the business school what that would look like, etc. So I'm very excited to do this. We as a firm want to help create the next generation of venture capitalists, but also help out entrepreneurs that might access venture capital in the future to just get some of that learning. So whatever role, small role we can play, and whatever limited knowledge I have, I'm very keen to share that. This year has been a little bit more challenging because of COVID, but I think next year, inshallah, you'll see actual defined courses on venture capital coming up.
I really hope I do, because it would be my senior year, and after that I'm leaving LUM. So I really hope that you start. So just one last question before we wrap this up. I think you're the best person who can deliver this message. So what is like this one brief message you can give to future entrepreneurs and future innovators right now?
So I think the message is really that I think the one thing that is in our control for success, if I'm boiling it down into three very simple factors of ability, talent, effort, hard work, or luck. In an ideal world, we would have 33% of each and achieve 100% of our success, but it's not an ideal world that we live in. And of these elements, the only thing that is in our control is really effort or hard work. And as someone wise once said, the harder I work, the luckier I get. My only suggestion is just keep at it. I don't think anyone, frankly, is in a position in this ecosystem to tell someone else, hey, you can't do this because it hasn't been done. Well, that's the very definition of someone looking to do something different, disrupt things, break things maybe in the process, but coming up with something new and valuable. So just keep at it. There's a lot of players in the ecosystem that are out there to support talented individuals and teams, and the right businesses will find funding, they'll find the next growth avenues, and they'll also find exits at the right time. So don't get distracted by too much noise. Focus on what are first principles, building strong, sustainable, profitable businesses. Stay true to your ambition. Be fair to the people that you're bringing on board. Trust them, and see the magic happen.
So I think that was like one of the best pep talks I've ever received regarding it. It's really motivating, and that kind of brings us to the end of our podcast. I'd really like to thank you, because I was really looking forward to this for the last like 1 year or so, ever since I started following Sarmayakar. So thank you so much, Rabeel, for joining us, and thank you for all the wisdom and insights you have imparted.